Really, a lot of people are wondering where is the next stress point in the market, because one of the interesting things about the collapse last year, and we've spoken about it lots, is that it didn't really touch traditional financial markets, the likes of stocks and bonds as well. But there is growing concern among experts that perhaps stable coins could be the next stress point, and any run or collapse of some of these big stable coins, the likes of USDC or Tether, any run on these stable coins could actually cause a ripple effect across traditional financial markets. Just a reminder, stablecoins are these cryptocurrencies effectively trying to be pegged one-to-one to a fiat currency such as the US dollar or the euro. They're supposed to be backed by real-world assets such as fiat currencies and even treasuries as well, and they've become huge. They really are the backbone of the crypto trading economy. Stablecoins are about $145 billion worth of market cap as well. As I mentioned, growing concerns here about what could happen in the event of a run on these stable coins. I caught up with Eswar Prasad. He is the Tolani Senior Professor of International Trade Policy at Cornell University. I started by asking what he fears in the event of any kind of collapse or run on the stable coins. Listen to what he had to say.
The key aspect of stable coins that keeps their value stable is the fact that they are backed up by reserves of fiat currencies, and typically these reserves are in the form of liquid government securities. So if you think about US dollar-backed stable coins, typically they hold, or at least we believe they hold, US Treasury securities as part of their reserves. And I think a concern of regulators is if there were to be a loss of confidence in stable coins, maybe because some exchanges come down or for other reasons, then you could have a wave of redemptions, which would in turn mean that the stablecoin issuers have to redeem their holdings of Treasury securities. And a large volume of redemptions, even in a fairly liquid market, can create turmoil in the underlying securities market. And given how important the Treasury securities market is to the broader financial system in the US, and this is true in many other countries as well, how important the government securities markets are, I think regulators are rightly concerned.
You speak to a lot of regulators. They're, one, as you said, concerned about stable coins, but what other aspects about the crypto industry right now are they worried about?
So from a regulatory point of view, as you pointed out earlier, the fact that we haven't had spillovers from this part of the financial ecosystem into traditional financial markets or into the real economy certainly seems to be suggestive of the fact that there is a firewall. But that firewall may not last, and I think from the regulator's point of view, all of the traditional pillars of financial regulation come into question here. Institution-specific and broader financial stability, market integrity in particular, if stable coins and other cryptocurrencies become an important part of the payment mechanism. And then, of course, there is investor protection. While Bitcoin was riding high and seemed to be riding even higher, a lot of investors, retail investors who didn't fully understand the risks that they were taking on, bought into these securities. And many of them thought that they were legitimate securities at one level because the government was, after all, asking them to report them as part of tax reporting. So there was this veneer of legitimacy that I think made a lot of people take on risks that they really shouldn't have been taking on.
You've spoken a lot about the marvel of Bitcoin really was the underlying technology of the blockchain, right? And that's been one of the big sort of positives that come out of Bitcoin and what's happened. When you look at sort of what happened in the market last year and just the collapse of so many of these different coins, you know, some of these digital currencies losing, you know, 80–90% of their value. What do you think happens next? Are we, you know, we've had cycles, so many cycles of being washed out and the market getting frothy again and washed out and frothy again. Is that set to continue, or will there be some sort of change at some point?
So there was this notion before the last year that perhaps Bitcoin and other decentralized cryptocurrencies are going to be financial assets that are not going to be that affected by macroeconomic fundamentals. Maybe they would even serve as inflation hedges. I think all of those questions have been put to the test and the cryptocurrencies have failed, because what they are at one level is really speculative financial assets without a clear valuation model backing them. So when interest rates rise, when the macroeconomic environment becomes less conducive to risky assets, Bitcoin and other cryptocurrencies take a beating as well, and because they don't have a clear valuation model underlying them, they tend to be even more volatile than other risky assets. And I think that is what we have seen very clearly in the last few months.
And Eswar Prasad's view there is one that I've heard echoed here on the ground, that stable coins and their issuers are not transparent enough with what they're holding in their reserves. And he thinks there's a lot of US Treasuries involved in that. And any kind of run on a stable coin could mean having to redeem and sell off these Treasuries. It could actually impact the bond market as well. And that's where we may see the point where crypto crosses over with traditional financial markets, if that ever happens.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.